All right, welcome back. We've got Rajiv Sabharwal with us now, the MD and CEO at Tata Capital. Lots to discuss with him, of course, particularly as we're heading into festive season and really what the outlook's looking like. Rajiv, good morning. When we're talking about consumer financing, what some of the trends that you've been observing on ground? How are things shaping up, especially as we head into this time of year?
Things have improved significantly from the time the lockdown started. I think so. Things started improving from May, and then month on month things have improved. If you look at different segments, the auto industry is back. In fact, it's seeing growth which it had not seen for the last few years. The two-wheeler industry was the first one to recover. We are seeing housing sales improve. In fact, in certain cities, these numbers are more than what they were a year back. And the interest rates are low. So it's probably a great time for customers. Two, I think it's also being helped by the fact that there was a lot of pent-up demand which was there and which is now coming out. So things have significantly improved. And if we look at volumes for different products pre-COVID and now, I think in certain products we've actually exceeded and more than what it was before COVID. And in some others, it's 70 to 80%.
Okay. Do you see the pickup also translating into disbursements, in terms of comparing it to really pre-COVID levels as well? How would you describe it? Where do you feel we're at in that process?
See, what is happening is that there are a certain set of players which are growing faster than the others, who are finding liquidity more easily available and at the right cost. So some players are showing growth which is more than what the market has, which has always been true for the industry. But on an overall basis, if we look at the numbers, put out by the regulator, then the growth is more closer to 5 to 6%. So the growth is lower, but it's significantly better than Q1. And the expectation is that in festive times, we could be back to more closer to, growth rates which were there before COVID started.
Rajiv, I'm asking a very simple question. With banks, we know the moratorium numbers. Tata Capital is not listed, so we don't know that moratorium number. Now that moratorium is over, how's the demand recovery shaping up for you?
See, moratorium was, there was a situation where certain customers were given an option to choose whether they wanted to pay their installments during that period or not. It was not so much about incremental demand. There was a fair amount of uncertainty at that point of time because you didn't know how things would shape up over a period of time, and people wanted to conserve money. So you saw, deposits in the banks growing because people were saving money rather than spending money. But what we have seen is post the easing of the lockdown, transportation starting in bigger towns, we've seen demand coming back. In certain segments, the demand has come back, has been slower, and in certain segments, it's been pretty fast. Like I told you, in the two-wheeler, as well as the tractor industry, as well as the passenger car industry, the demand has been pretty robust, and so has been in the housing industry. So I would say that there are segments where it's been coming back, and there are segments where the demand is the offtake is slower.
Okay, Rajiv, where is the demand coming from? I'm asking this question perhaps to everyone who's coming on the show, because banks and NBFCs ultimately are a reflection of economy. The economy has contracted, unemployment has gone higher, salary cuts have started, barring few IT, pharma and some digital companies and startups, which are a handful of them, which don't even employ 1 million or 2 million people. Everybody has taken a hit, and yet demand has come back. So I'm just trying to understand here. Is it because people are dipping into their savings or something which we don't understand right now? We'll be surprised with economic data later on.
So let me break it up into two parts. And let's talk about, where things are positive and things are looking up. and where there is some amount of apprehension in the industry. First of all, if you look at the growth has, one is the organic growth, which you get because of, people wanting to buy more products. And we have seen this, more consumer durables are getting sold. Online sales are pretty good. If you go to the auto dealerships, you would find that there is fair amount of growth there. Same is true for the auto. If you talk to builders, there is growth. So one is growth coming in organically. The second is the government also brought in certain schemes to support growth. For example, the MSME scheme, the credit guarantee scheme, where you could extend up to 20% of the, the amount which you've lent before, and there is a government guarantee. That has also helped bring more credit to the system. More than 1.5 lakh crores, 1,50,000 crores have been dispersed, in that scheme. The third is also some players are seeing growth coming from balance transfers, which is because the interest rates have gone down, people are moving their loans from high interest rate to low interest rates. So that is a growth being seen by one player, but there is a loss of the other player. So that doesn't give you systemic growth. Systemic growth is coming from the organic growth as well as, like the MSME scheme or certain people wanting to expand certain capacities, for example, in pharma or some of the other industries. And if I have to break, all of this up, probably I would say 1/3 is coming from each one of them. As far as, the point which you raised, Nikunj, and that is an apprehension which the industry has, because what we are seeing this time, in the market play out is very different from what we have seen earlier. In the earlier times, we saw the stress coming in from large corporates, the infrastructure side. But this time, the stress is not so much on large corporates or infrastructure. The stress is coming in from certain segments in the retail, which people want to watch over a period of time. And that is because some MSMEs have taken longer to kickstart their business. There are certain segments which have been hit, the hit has been deeper. And third is because what you just mentioned, that a certain set of people have seen a reduction in salaries or bonuses being lesser or bonuses not being coming. So that's pulled back a little bit of the demand. So there are both sides to the whole story. But on an overall basis, I see more positive things than negative things. That is how I will put it. In fact, when we are looking at corporates and talking to them, there are a lot of people who had gone in for salary cuts, but they are coming back and saying we no longer need those because the economy is coming back in shape and we actually need employment. So we are seeing both sides of the story play out, but more is on the positive side than on the other side.
Rajiv, how is it that you're planning to ramp up your digital infrastructure, and where exactly do you see the future of digital payments headed at Tata Capital?
See, digital became the core of everything, and that's not true for us. It's true for everyone in the market. I think so. Everybody has disproportionately spent on digital infrastructure. So it's and if you talk about competition, it's not about what you spend or what infrastructure you create. That's the basic thing. But more importantly, how do you use it? How do your customers adopt it? How do your employees adopt it? And how do you see more business happening? So we are clearly seeing digital play a significantly important role in all parts of the business, whether it's customer servicing, whether it's incremental sales, whether it's robotics at the back end in the operations, or even in collections. We are seeing digital actually pervade everywhere. For example, just to give you an idea, on a home loan side, more than 95% of our payments get collected digitally. So, this pervasiveness is increasing over a period of time.
Sure. Rajiv, just an extension to that point, there are reports doing the round that Tatas are planning a pan-India retail payments network and that Tata Capital will be playing a very crucial role in that. Is there any truth to this? Any such plans?
See, payments are like an infrastructure for any industry. These are the railroads on which money moves. So is payments an important part of any business? Payments is an important part of any business. But I don't think so, there is anything which I can comment about what the group wants to do. Everything is premature at this stage, and I really won't like to comment anything on that.
Rajiv, what about housing loans? What's the kind of outlook or scenario there? What's the kind of trend you're observing?
In fact, housing is one industry which has really surprised us, to be honest. There was a time when this whole pandemic started and we were really wondering and saying that housing is going to go through difficult times because it's been through bad times over the last couple of years and it's just going to extend. But we were pleasantly surprised because of multiple reasons. One is, I think people realize that they want their own personal spaces because that gives them safety. Two, we also realize that people want some bigger spaces because now the offices move to home. So clearly that became more important. Third is, I think RBI and the government did take significant steps in ensuring there is more liquidity and the cost of money comes down. So the cost of acquiring a new home has come down. Along with this, like, for example, if you see Maharashtra, it's dropped stamp duties like it has never dropped before. So, all of this is combining together. Besides this, developers, especially in the affordable housing segment, are offering significant discounts. So the prices of property are low. The transaction costs have become lower. Interest rates are low. People want to acquire home loans. So I feel that if you look at Q2 and if you look at in Q3, you'll be surprised to see the sales in this period more than what it was in the same period last year. But I would say more so it's there in the right segment, in the affordable housing segment.
Sure. Any guidance on credit cost as well for FY21? How are you analyzing the funding scenario?
See, first of all, I think as far as funding is concerned, there is ample amount of liquidity. Thanks to RBI that there is money available. If you've got good financials, there's no reason why money will not be available. Two, the cost of money has also significantly come down. And that's getting translated into lower rates for customers, which is helping the market come back faster. So liquid, plus, there is enough money available outside. If you want to raise an ECB, you'll have to, look at, what the hedging costs are. But otherwise, there is sufficient liquidity available. And I don't think so that will change during this financial year. We should see, good liquidity at affordable interest rates available throughout the year. As far as credit costs are concerned, that's an area to watch out for. I think Q3 and Q4 will be crucial. According to me, Q3 will actually tell you a good trend about what to expect in the future. However, let me admit that compared to what one thought at the beginning of the pandemic starting off and the lockdown starting off, today we feel far more comfortable on credit costs. Because a lot of upfront provisions have been taken by most of the companies through by using macro provisions or creating macro provisions, which the RBI advised. So, will the credit costs this year be higher than last year? I think so. They will be higher than last year. But is there something to worry about? I don't think so. In fact, even when you look at the restructuring scheme which has been brought by RBI, if we overall look at the industry also, I don't think so we will see anything, south of 5%. Everything will be south of 5%. Nothing will be over 5% among companies, and it could be significantly lower than that. So the restructuring is going to be lower because credit has behaved slightly better than what it was expected to.
All right, Mr. Sabharwal, we'll let you go on that note. Thanks very much for taking time out and walking us through the outlook in terms of trends for consumer financing as well as the overall demand scenario ahead of the festive season.